Peter Boockvar is Chief Investment Officer at Bleakley Financial Group and a CNBC contributor. Peter, great to have you with us. Bonawyn just said he is begrudgingly putting money into the markets. That was his motto in Q4 as well. Are you ultimately, I mean, I understand that you think the economic data is going to turn and work against the markets, et cetera, but at this point in time, do you acknowledge that the market seems a little bit stronger than what you may have anticipated going into this year?
Yeah, well, certainly the last couple of days and how we ended last year. But I understand the market's desire to rally on expectations of Fed rate cuts. I mean, that's been the playbook for decades now. So I get why we rallied. I think earnings over the next couple of weeks are just in time in the sense of testing the thesis that everything is fine. And there are just so many mixed signals within the global economy that it just can make your head spin. When you look at holiday sales, for example, you have the MasterCard spending pulse. You have the National Retail Federation saying that holiday sales were about 3.5%. Well, that's the rate of inflation. So on a real basis, holiday sales were zero. U.S. manufacturing, global manufacturing for that matter, are in a recession. You have the pace of existing home sales near 30-year lows, but home building doing okay. You have high-end spending on travel and leisure, hospitality, restaurants doing fine, but spending on stuff not doing well. And if you looked at the Beige Book last week, of the 12 districts, 8 basically saw no growth. You had 3 that saw modest growth, 1 that saw a modest decline. That doesn't sound like a great economy. So and then you look at overseas. Europe is essentially at best flatlining. China, we know, is further decelerating. So it's really a tough environment to both figure out and maneuver through. And I think the stock market is really trading off. The Fed is going to not be in our face anymore, and maybe even NQT2 to throw that in there, and just buy stocks because of that, rather than a real analysis on the full macro.
So, Peter, when you would admit that the market is taking its lead from the Fed. If the Fed cuts, the market's going to rally. That's been the standard. What can QT give us a clue on right now? Should we watch for that to stop first, and then the cut is coming? Because you can't have both at the same time, I wouldn't think.
Well, I think that's an internal debate within the Fed. Can they continue with QT because Jay Powell wants to get the balance sheet to a level that he's comfortable with, which he can't even define, actually, but at the same time sort of tweak monetary policy on the rate side to reduce the odds of a recession, but not cut too much that you stoke higher inflation again. And this is a very difficult situation that Powell's in. I think his main priority right now is not to stoke a flare-up in inflation. He thinks he's got a handle on it with the downside of the cyclical spike, but keeping inflation low is his next battle. And I think it's really going to be interesting to see how the Fed plays the balance sheet with what they do with interest rates. But even the interest rate story is a trade-off. If they only cut a couple of times, call that maybe just a tweak, and the Fed funds rate's still going to remain high. If they cut 6 times, 7 times, that's because the unemployment rate's going to 4.5 to 5, and we're in a recession. So this is not an easy situation to really analyze, and from the Fed's perspective, to actually maneuver through.
Peter, it's Karen. Thanks for being on. So for a while, we've talked about this idea of a long and variable lag. Has enough time passed through when the Fed started hiking aggressively that we've seen what the lag is, or do you think that there's more to come on that?
I think this is going to take a few more years. This year, we have about $750 billion of corporate debt that needs to be refinanced. Now, granted, some of that took place in 2023, but that rises to over $1 trillion in 2025. You have about $500 billion of commercial real estate that needs to be refinanced. And I've spoken to just over the weekend to some real estate people that are just crossing their fingers that the 10-year yield goes down to 3%. Because if rates stay around these levels, with their debt coming due at the latter part of this year, they're in trouble. So I still think that this has many years to sort of work its way through the refinancing cycle. And that is going to be a continuous drag on economic activity. Now, that said, when you look at those companies that borrow SOFR plus, well, if the Fed's going to cut, maybe they've seen the worst of it. A lot of small, medium-sized businesses do borrow floating rate. So ironically, it could be the bigger companies that are going to see the jumps in interest rates. And we have to remember that one of the main contributors to profit margin expansion over the past couple of decades was lower interest expense.
Peter, what do you make that's going on in China? The FXI closed around 21, levels we probably haven't seen in 16 or so years. Is that any reason for concern whatsoever?
Well, it's certainly a concern because it's the second biggest economy. But if you showed me that chart and I didn't know what it was called, I would say that this is final capitulation. Everyone's just throwing up, and this is the bottom. And I actually think that is the case with the Hang Seng Index. And I've been dead wrong in the first 3 weeks of the year calling for the Hang Seng to outperform the S&P 500 this year. But I still think that this is the sort of the final leg of the bear market, specifically Hang Seng, the H shares. The A shares much more complicated and tied to Chinese policy, where there are a lot of companies within Hong Kong that have global operations and particularly operations throughout the region of Asia.